The IPO window opened once again, which could offer relief for some limited partners who have been strapped for quite some time for liquidity over the past decade as more companies stay private for longer. Joining us right now is Hany Nada, co-founder of ACME Capital. He has backed the likes of Alibaba, DraftKings, SoFi, and so many other companies through multiple venture capital cycles. But this has been a particularly unique one in terms of just the length with which these companies have remained private. What's your expectation going into 2026 in terms of how much money ultimately gets delivered back to the limited partner community?
Good morning, Andrew. Thank you. Look, I hope it's going to be a lot because for the last 10 years, we haven't done, as an industry, we haven't done a very good job of giving our LPs back capital. It's been really easy to stay a private company for the last 10, 15 years, given how much money has come into the asset class. So we've had a lot of LP dollars coming into the asset class, creating these mega funds who are able to invest millions of dollars, tens of millions of dollars, and oftentimes hundreds of millions of dollars into these small private companies. So when you're a small private company getting a better valuation in the private market and you don't have to do the regulatory scrutiny of being public, why go public? And so that's been the biggest issue, I think, for the IPO market, especially from the tech scene.
When you look out longer term, do you think we're going to go back and look at these vintages of companies that stayed private this long and say that was the right move, that was the wrong move, that was a mistake? Do we want to change the incentive structure so that these companies do go public earlier? Is that better for the public markets? Is it better for you?
Look, I think the longer the company stays private, probably the better the quality of the company when it ends up going public. However, you do miss out on a lot of the growth these companies see. Most of the growth happens in these companies, I would say, between year 5 and year 10 of their life cycle. And when they're spending those years in the private market, the public market investors are not getting the benefit of that growth. And so when they're coming public, they're probably a little bit slower growth company than they were 3 or 4 or 5 years ago. So that's one aspect that I think the public market shareholders are missing out on, which is frankly why you're seeing a lot of these 40-Act companies or 40-Act funds come in and saying, hey, we're going to get you into these best private companies before they go public, whether it's SpaceX or Stripe or have you in the secondary market. So I do think some of the public market investors are missing out on some of the growth of these private companies before they go public, given how long they're staying private.
Okay, so now I'm going to make you the SEC chair, or I'll make you the president of the United States if you want for a moment here. What would you do to, quote unquote, make IPOs or make being public great again, if you will? That is a mission of this SEC and this president. And I wonder what you think you could do that both creates enough disclosure and enough transparency for the investor class in the public markets, but also makes it attractive both for the managements of these businesses and for folks in your business.
So absolutely reduce the regulatory burden on small private companies or small companies, public companies. When I started in the business, an IPO would be a company that was doing $30 to $50 million of revenue, doubling year over year, getting a great valuation and getting a lot of public market support. That's no longer the case. You've got to be $500 billion in revenue in order to get public now. And because of the regulatory burden and the expense associated with being a public company. And so look, Frank Dodd was probably one of the worst things that happened for the IPO markets for these small private companies. And so there's lots of regulations that I would probably get rid of.
But how much of it is it cost, like actual economic cost versus mindshare cost? Meaning the idea, a lot of CEOs don't want to have to do quarterly phone calls. They don't want to have to take a week out of there. And this is why the president's talked about, making earnings calls and earnings announcements only twice a year. Now, by the way, on the flip side, even people like Ken Griffin say that's a bad idea. You want the transparency. So here you have sort of a mismatch of interests that are not aligned, oddly enough.
Look, I think we can't get over the fact that the public market tends to be very short-term oriented, while private market and private investors tend to have a very long frame. Somehow you got to cross that gap. I do think it's both a mind share and a capital share problem that you just outlined, Andrew. I don't know what the best way to solve that, frankly. But I do think you have to enable small companies to go public without the scrutiny that happens today and the headache of trying to, maintain, all the regulatory rules for it.